Well, welcome everyone to our Cash Flow and Solvency for Business webinar. Thank you for joining us today. And my name is Tanya Titman. I'm joined by Shaun, McKinnon, and together we're going to navigate this space of cash flow and solvency over the course of the next hour. We understand it's a difficult time for businesses at the moment, and cash flow is certainly one of the most critical elements that we find businesses are needing some more clarity around. So hopefully throughout the course of today, we'll take you through some ideas, some solutions, and some tips in terms of how you can best navigate this time. If you do have any questions throughout the webinar, there is a panel where you can submit questions, and we will endeavour to be answering those as we go through. So if there are things that you'd like further information on, please feel free to put those questions into that panel, and we will be addressing those to the best of our ability as we go through. If there are things that we can't actually provide answers for because perhaps we don't have all the information at hand just yet, we'll do our best to circle back with you after the webinar. So before we get started, just a quick introduction, and I'll hand over quickly to Shaun just to give an introduction, I suppose, in terms of his role and what he sees in this space.
Thank you, Tanya. So good afternoon, everybody, and thanks for joining us. By way of quick introduction, my name obviously is Shaun McKinnon. I'm a partner in the advisory practice here at BDO. I do a couple of types of work within the firm. I work in the corporate finance sector and also in the business restructuring sector. In the corporate finance sector, my work is typically financial due diligence, private capital raising, and a little bit of M&A. And on the business restructuring side, my work is more related to businesses that are experiencing some sort of distress, right through from engagements ranging from turnaround engagements, helping boards and management work through cash flow pressures and financial issues, right through to the other end of the spectrum, which is the insolvency side, so acting as an administrator, etc. Look, this is pretty topical for us because in the business restructuring side of our practice, we are often dealing with businesses that are going through cash flow crises, which is effectively what the COVID-19 situation has done or has caused for otherwise healthy businesses. So I'll be giving some insight, I guess, from that perspective today. Thanks, Tanya.
Thanks, Shaun. And welcome everyone. My name's Tanya Titman, and I'm a partner here at BDO from primarily a business services background and deal with SMEs and provide a whole lot of solutions around educating and empowering business owners and their teams with financial information and the tools to get greater clarity around things such as cash flow. So really keen to share some of my insights, what we're hearing from businesses and the way that they're approaching cash flow quite differently now to perhaps how they may have done it in the past. So let's kick straight into it. What we're going to be covering today is essentially looking at this cash flow issue and how it differs now to how we have been addressing it in the past. Some ideas around where to go, what to look for, and how you can actually stretch your cash flow further. We're going to touch on just some of the government stimulus packages. We're not going to go in too much detail there because there still is information emerging, and we've got a great webinar which is on Thursday, which is specifically around the JobKeeper stimulus, and we're waiting on that legislation to be passed, which we expect to happen tomorrow, and so we've got a webinar scheduled for Thursday. So if you have specific interest and want some clarity around that JobKeeper subsidy, then please go to the BDO website and register for that webinar, which will give you all those details once we've gone through and assessed that legislation hot off the press, hopefully tomorrow. We're also going to just explain, some various ways in which you can approach this in terms of using 90-day business plans and how you best work with your advisors to implement those. And Shaun's going to take us through a whole lot of information specifically from his experience from working with businesses and tap into some of these areas such as your company director obligations and ways in which you can get help to get you through this next 6 months.
And
So
Tanya, I
kicking
might
up,
just,
sure.
if I could just say on that point, I think one of the things that we will explore as we get further along is not just how do you manage your cash flow through this period, but how do you make sure that your overall solvency is staying intact and what to look out for around that.
Great.
Thanks, Tanya.
Thanks, Shaun. All right, so we're going to keep this pretty interactive. I'm going to pose a few questions to Shaun, given his background and his great experience in this area, because I think he brings a lot of perspective to it. So we'll work through this together. And again, if you do have questions as we go through, please feel free to put those into the question box. So why does it look different? Well, I think everyone's experiencing a lot of pain at the moment in terms of either a forced shutdown situation in business or some certainly very different trading conditions to what we've ever experienced before. So now more than ever, it is really key that you have some clarity around your cash flow position. And I think certainly from a lot of businesses that I've been working with and helping them get models into place, what we're seeing is that typically businesses and their teams, they've worked on monthly cash flows because this hasn't been such a critical issue, and generally a monthly cash flow might have been sufficient in terms of giving them enough insight. What we're finding is because the environment is changing so quickly, and gosh, the last few weeks has probably felt like the equivalent of many months, I think, because so much is changing. It's now really important to get more granular with your cash flow. So having weekly cash flow models as a minimum and being able to understand and construct them in such a way where you know the levers that you can pull, you can get to that information very quickly, and you can really, pull apart the cash flow and keep it up to date and relevant as things are evolving very quickly. And I think that's a key part. And Shaun's got some great insight, because often over the years, the types of businesses that he may have been assisting and helping are ones that are in this sort of critical cash flow crisis position. So Shaun, just some interesting perspective for you to share, I suppose, in terms of how you approach those types of businesses, quite different to, I suppose, businesses that are trading with no issues.
Sure. So look, the first thing I would say is that if you're operating without a robust cash flow, it's sort of like driving your car while you're blindfolded. This is the critical part of any business that is financially stressed through things like COVID-19. So what we always do with any business that we start working with, whether they're solvent or whether they're in administration, is really look hard at building out that short-term cash flow. And we start by looking at daily cash flows for the first 2 weeks, and then building out that weekly for about a 13-week period. Because usually that 3-month period is a period that you can forecast with some sort of reasonable accuracy.
And through that process, I suppose what that's giving you is this ability to look out for that minimum of 12 weeks and see how far your cash flow is going to get you, how many weeks of cash flow you have left. And if you know that in advance, then you have the ability to kind of pull levers and to do things that may stretch it further. But if you're living day to day and you don't have that level of detail and you can't find the levers easily that you can pull to stretch it, then it just becomes, really, really difficult to manage. So getting that ability to look out. Now, a lot of people I find don't rely on cash flow forecasting, don't have them in their business because one, they may have not needed it. Two, they find it too difficult to get that. I suppose they look at it as it is crystal ball gazing. How do we actually even comprehend what the future is going to be like based on, I guess what's been thrown at us in the last few weeks? And that's a really critical part. And Shaun, in terms of how you look at that from a business, what sort of things would you typically be looking at to kind of readjust and to keep relevant with the latest information that you know to give the most accurate forecast?
Yeah, well, look, it's a unique situation, this COVID-19 situation. We've got some businesses that we've been talking to over the last few weeks who literally went from healthy, trading along fine to having zero revenue but overheads accruing. So the starting point for us in this new world forecast is really critically going through and understanding, well, what's changed, and making sure that you've accurately forecasted where your revenue's gone and what are the costs that you can reasonably remove from your business that would be considered discretionary costs.
Yeah, great. All right, so in terms of a cash flow forecast, the structure of it is really quite simple in terms of we're starting with, what cash do we currently have, what cash is flowing into the business, what's flowing out, and then sort of looking out those 12 weeks and resetting that cash flow forecast each week. One of the things that we find really good for businesses to do is actually to break out each of those areas a little bit more. So when we have cash flowing in, you have cash sometimes which is of a recurring nature that you expect, is coming in, and then you have cash coming in which might be less so. It might be of a variable nature. So it's really hard to understand. It's going to likely change quite regularly, but what we find really helps, and again, it's going to be continually looking and updating your information with the latest information that you have at hand. But even if you look at your bank balances over the last, or your bank accounts over the last 4 weeks, and look if there's a pattern of income, and typically we find in business there is a pattern depending on the payment cycles that you're dealing with your customers or your clients. And so trying to understand and see that pattern that's occurring into the business and building that into your cash flow really helps. And it's a weekly process as a minimum. Sometimes as Shaun was saying, it may be daily, but as a minimum, this has to be a weekly process. And by investing that time in it every week, you're getting it more and more updated and more accurate with the latest information that's coming to hand. The same goes for your cash flowing out. So we like to break this up again and into sort of areas where you can easily see the parts that you can move and manipulate in terms of your cash flow. So for example, if you've got cash that's flowing out of your business, which is of a recurring nature, it might be loan repayments, it might be sort of direct debits that are just coming out of your business bank accounts on a regular day, every month or every week. It's a lot more difficult to do things, to change those. So breaking it up into automatic payments that are coming out and what variable amounts are coming out. So they're the things that you have control over. So you can control the timing of those particular payments going out of your business, and therefore it is a lever that you can pull. You can negotiate some supply terms. You can look at ways in which you can push out some of those payments to smooth that cash flow and get yourself in a cash flow positive position. I also then recommend putting your staffing costs as a separate piece in the cash flow. So you're kind of building out all of the elements and then bringing it into an overall model at the end. And the tax and super and compliance pieces of your business, I also like to see as a separate element. So when you start breaking it out in this way, all of the pieces of your cash flow are much easier to tap into and to sort of look at how you can, I suppose, use those levers to stretch your cash flow and make strategic decisions rather than having it all in one piece. So Shaun, any comments or further sort of insights that you'd like to provide around the construction of your cash flow forecast?
Look, I think the important thing to reiterate is what you've talked through there, Tanya, which is the importance of getting really granular and working through line by line. It can be a little bit laborious, but it's really important to make sure that line by line you work through that cash flow and get a really detailed account of exactly what's coming in, what's coming out, and what the potential discretionary areas are.
Yep, great. So one of the questions that we've got, I'll just bring up here, is our cash flow is largely dependent on debtor collections, which is unfortunately largely out of your hands. So any advice on maximising collections, please? And I think that's a really common theme that we're seeing that's the piece that you want to be able to really micromanage at this point in time, and you're going to have to continually work with your customers to to work together to get solutions to, to ensure that this doesn't become a problem. So you might be identifying that that's a key area of the business. Now the impact may start to come through in the next couple of months if it hasn't already. And I think this is an area that every business really has to focus in on. And so again, Shaun, any tips specifically around that sort of debtor management?
Well, we're in a really different world than what we would normally be in. What we've been talking to clients about and what we're advocating for is very much about supply chains, sharing the pain to make sure that everybody can move forward. So there's no easy fix for this, but it does involve a lot of interaction with your debtors and making sure that you're having the conversations with them, you're making arrangements with them that provide for whatever cash that they can afford, that ensures that you are able to maximize your cash flow as well. Yeah. The important thing, I think, is this is a bit of a different world, and we need to work together within our supply chains to be able to make sure that all of those within it have the best chance of working through it.
Yeah, so communication's just key, I think, and ensuring you're staying in touch and you're trying to create, I suppose, solutions that are accommodating all parties, because everyone is in a world of pain, certainly in the business community at the moment. Okay, so we're going to just move on to looking at, identifying where you can cut costs, increase revenue, and stretch your cash further. And, some of the ways in which you might look at doing this is certainly reviewing your profit and loss and balance sheet, looking for any, what I refer to as discretionary expenditure. So when I sit down with businesses and we look at their profit and loss, we often find that there is a lot of what I call fat in the business, and it comes from being able to look through and identify every line item and scrutinize each piece of your profit and loss. And look for ways in which, is that actually needed for the operations of the business? So constructing a financial statement and a profit and loss statement that really looks at the operational aspects of the business and questions every single line item. I find it really useful for businesses to create almost a category called discretionary expenditure. And it's all the things that you don't need to actually operate the business. They're the discretionary items. They're often the things that are nice to have when times are great, but when times are tough, like we're experiencing now, it gives you a go-to list of things that you can actually cut back on immediately. They're not essential for operating the business and certainly for your business strategy. So look for those things. Anything that is non-critical, then you should be looking to eliminate those expenses immediately, and also looking at any expenses that can be deferred, adjusted or deleted. So looking at all the pieces. I find software is often a huge area where we sign up to things, we put systems in place, but if you really break it down and you look through what subscriptions have you signed up to, there's often lots of savings in that area. And it's just, if you go through each element and find these pieces overall, you can actually find quite a lot of savings. Also looking at any assets. So when you're looking at your balance sheet, is there any assets that might be able to be converted to cash? So just looking at the utilization and whether they're required or not. And looking at negotiating any payment options with suppliers. So there's a number of things there, and I kind of put them in this category where we talk about cash flow levers. And if you really break it down, we have some great tools which is around these cash flow levers, and just some thought-provoking questions around things such as your pricing, your volume, accounts receivable. So if we're looking at how we can increase cash coming into the business, you've got these three elements. So you can get better with the data collections and keep tight with that. Looking at volume and how you can increase the volume in your business, and also looking at your pricing strategy. So reviewing all of these elements and making small adjustments overall can make quite a big impact. And if we're looking at reducing the cash that's going out of the business, then we're looking at things such as our asset utilisation. We're looking at our staffing. So how can we actually make better utilisation of our staffing resources? Do we need to reduce the hours or the capacity? Have we got too much in the business? What can we do to actually stretch our cash flow by using our human resources more effectively? Also looking at inventory and ensuring that our inventory utilisation, we're not holding too much at the moment, and we've spoken about the expenses. So when you put it into those two categories, it's just a nice way to look at it, and there's a whole lot of questions that you can drill into and ask yourself. So there's some really good tools there that if you're interested, please reach out to us and we can make those available to you. Just stepping through to our next piece, which is really around government support options. Now, there's plenty of these at the moment, and lots of information coming through, and probably a lot of confusion for many people as well. We're not going to go into this in great detail today because there is actually, there's some further webinars which we're providing, and I mentioned the one that's coming up on Thursday, which will give you some really great insight into the JobKeeper legislation and where that stands. So it is about just understanding what measures impact on cash flow and looking at the timing and how those affect. So a great example is, I suppose, the JobKeeper subsidies. So with those coming through, there's a whole lot of great cash flow benefits which will come in, but there's a delayed timing on it in terms of when they start. Now, we'll have more detail around this on Thursday, but understanding all of the elements of, you've got net wages going out, you've got PAYG withholding, which you've got to pay, you've got cash boost through that PAYG withholding stimulus. You've also then got these JobKeeper subsidies coming in. The timing of those are all very different, and if you're trying to work that out in your head, it's almost impossible. So you need to build this into your cash flows and try and predict that timing with as much accuracy and information as you have to know what the impact is on your business, and can you get your business through to a point where you can take advantage of these subsidies. And then, with that, just ensuring you understand the long-term impact of things such as deferrals. So, a lot of people are getting relief in terms of, say, the loan repayments and deferring those. So it is a deferral, and many of the initiatives that are out there are deferrals. So all that means is we've got an escalating commitment at the other end. So really be very careful in terms of looking into some of those deferral options and ensure that you really do need it. Don't just opt in because it's there, because it will provide an escalating commitment at the other end that you will need to factor into your cash flow going forward also. Any final thoughts on those points for you, Shaun?
No, just to reiterate that last point you made, I think, Tanya, and we'll talk about it a little bit more in a minute, but we're talking at the moment about managing your cash flows through a really difficult period. So the first thing we always look at is cash flow, but we need to have an eye on the future and make sure that we understand the obligations that we're taking on and what that means for the business as we sort of get to the end of, hopefully, what this crisis period is.
Great, thank you. All right, now I'm going to hand over to Shaun to take us through the next part, which is really looking at some action plans and how do we sort of bring these things to life in the business. So over to you, Shaun.
Thanks, Tanya. So look, I guess where we're at now is we've sort of gone through some of those basic, 101s of cash flow management. So let's assume that you've run into this initial COVID-19 problem. It's created a cash flow crisis, and you've gone through the steps that we've already outlined. You then need to think about, okay, what does that cash flow look like? And we would advocate that you need to build that into a 90-day business rescue plan. And you may not necessarily call it rescue, you may call it recovery, or you may just call it your COVID-19 plan. But the important thing is to understand how we're going to get through that 90 days. And once we've looked at those first couple of items, there's a couple of other things that are not business as usual that we would usually go through and look at. So Tanya, if you can just flick through to the next slide. So the first one is standstill agreements. These are fairly common in restructuring or turnaround situations. And what we're really talking about here is negotiated repayment holidays with your major creditors. It would typically be your suppliers, landlords, and statutory creditors like the ATO. Why they're important is if you get through the initial look at your cash flow and you still think you've got a bit of a hole, this is an opportunity for you to make a really large and immediate major cash flow impact that can buy you some time. But you need to be very transparent and upfront and proactive with seeking these standstills. And what I mean by that is, once you realise that you do have a requirement for them, you need to be active and go and talk to those creditors early. You shouldn't be waiting until it gets to a point where you have no other alternative. The other side to this is you have to have a plan. So we don't want to be asking for a standstill agreement with key creditors if there isn't actually a way out of it at the other end. So some of the things that are typically going to be asked of you if you're seeking a standstill agreement, and keep in mind, when we say standstill, we're really asking you to go and talk to some of your key creditors and ask them to receive no payment for a period of time. Now, that plan will usually need to demonstrate that what is happening post this plan. So when are they going to get paid? You'll need to be able to demonstrate to them that they're not the only creditors, hopefully, that are taking this sort of pain. So explain how other creditors are impacted and how other creditors are sharing some of this pain. You'll need to demonstrate things to them as well, which are always topical, such as confirming that directors aren't taking any additional money out of the business, or that directors have shared the pain in some way as well. But if you can present to your creditors a detailed plan, this is a really effective way and an important part of a turnaround or a restructuring situation to be able to buy you some cash flow time. If you want to just flick over to the next one, Tanya, the other thing that we usually talk about, which is really critical, is looking for additional capital sources. And there's a few different places that you can look for those. First of all, we would recommend that you understand the collateral that you've got available to support that finance. So what's the current loan to value ratio that sits within your balance sheet? Are there other assets that you haven't provided as collateral to your financiers at this stage, which you could use to generate some cash inflows for the business? And we'd always recommend that you bring your financier into the tent, as we say, really early and be completely transparent with them. When you're working through cash flow issues and working through issues like everybody's facing right now, your financier can be your biggest ally, but they need information and they need to be able to justify the measures that they take to support you. And the best way to achieve that is by constant communication and working with that financier to be completely transparent about where you're at. All of the major banks have released pretty generous packages at the moment in relation to how they'll support their customers. The major one being that most banks are providing a 6-month relief from repayments, to deal with this immediate impact. And our experience when we talk to different customers is that banks are providing that fairly willingly at the moment. So there is a lot of goodwill and support in that side of things. Other things we look at, is there other capacity in your balance sheet for you to generate some cash? So these would be things like, do you have surplus assets that you could generate cash from that you may be able to sell? Do you have, for example, debtors that you might be able to borrow against? So look for those other sources. And then the final one, obviously, is equity capital. And this is really important. The great thing about equity capital, at the moment in particular, is that it comes with an immediate cash flow benefit, and it doesn't come with any cash outflow requirement. So unlike taking on new debt, which you'll have to repay initially, the equity is obviously linked to the future profitability of the business in terms of cash outflows. So it's an opportunity to bring in some patient capital potentially to be able to help you manage through these cash flow forecast issues or these cash flow issues. And there's a few different sources that you can look at. The obvious one is your existing shareholders. But now's an opportunity to look outside potentially your own network. There are a lot of professional investors, private equity, investment funds, different types of capital that sit out there that may actually be able to be utilised in this scenario. And it'll be different for different sizes of businesses, and it'll be different for different types of businesses. but this might be an opportunity for you to be able to seek those other sources of capital. Now, it's obviously not the greatest time in terms of getting value for money for that capital, but it may be able to put you in a position that gives you a much stronger balance sheet and a much better cash position that positions you for strength when you're ready to trade out of this when hopefully the COVID-19 situation passes. So if we can just roll over to the next one. Thanks, Tanya. So now you've looked at all of these different items that we've talked about. What we recommend is you build that into a 90-day plan. And I said at the beginning of this seminar that 90 days is our rule of thumb, because typically that's the period in which you can forecast out with a degree of accuracy. Usually out past about 3 months, it becomes a little bit more varied and a little bit more difficult to put your finger on. And those usual rules of thumb are probably a little bit less relevant as they've always been because of the fact that things are changing regularly. But that's still the period that we would recommend. And what we're really looking for here is once you've built that plan, it should include a series of measures. It should be structured and a series of accountable measures that people can take forward in a defined time frame. And it's all supported by a cash flow that hopefully, when you've completed this exercise, demonstrates that you have enough cash to trade through the next 90 days. And if you can trade through that next 90 days period, if you've got cash to get through that period, then in a period of business crises or business stress, that's the starting point. Understanding that you've got that 90-day runway, you've got the cash flow to be able to deal with that. And then you can look at what happens next and what are some of the other impacts of the current process that you're going through. So if we just jump across into the next phase of this, which is obviously working into the implementation phase. So you've built your cash flow, you've got a structure in place for a plan, you've got a series of measures. It's critical that this is something that in times like these, it is driving your business. So this is something that every Monday you should be revisiting. Most likely, most businesses have some form of management team that is specifically dealing with these COVID-19 pressures and stresses. That team should be meeting every Monday, updating this forecast, going through what it means. We know that things are changing. We know that inflows and outflows will keep changing as we see the impact of this develop in different parts of the economy, as we see government bring out separate measures. As we sit here today, I understand the National Cabinet is meeting with a view to releasing some guidance or a code of practice around how they deal with commercial tenancies. That's going to be a massive issue for everyone, which could materially change the way cash flows look depending on what sort of support they offer and how they structure that. So the key part here is this is an evolving situation and you need to be proactive and you need to keep monitoring that cash flow every week, updating it, and make sure that you have a robust strategy which is constantly tested, stress tested, and updated. So let's say we're in the middle of this. We've got through our 90-day forecast and we're moving along. We need to have an eye on the future. And what I mean by that is this is more than just about cash flows. A lot of the measures that government has produced and that financiers have offered do in fact make massive differences in how you manage your cash flow. But also in a lot of those cases, we're really talking about a scenario where we're pushing liabilities down the track. We're not forgiving them. You know, we've got some measures like JobKeeper and refund of certain PAYG, which is the cash boost, obviously, that do provide a cash inflow of sorts. But then you've got a series of other measures which, for example, delaying financial repayments from your bank debt by 6 months, or the ATO has publicly commented that they will give extended repayment terms. They'll delay your ability to repay certain tax liabilities, as well as enter into those longer term, low interest repayment plans. We've got payroll tax deferrals that have been offered through to the end of August here in Queensland. But all of these don't go away. All of these keep creating liabilities. And while you keep your business open, you are also incurring liabilities. And we just need to keep one eye on this to make sure that we're not getting ourselves into a position where at the end of this 90 days or at the end of however long this COVID situation impacts your business, that you haven't created a hole that you can't dig out of.
Shaun, just a question that has come through, just in terms of how would the concepts that we've presented here be applied to a business which essentially is unable to trade during this period, for example, licensed premises? What are you saying to businesses that are in that situation where they've been put into a forced shutdown?
Look, it's a really good question. We've got a number of clients in that space and we've been talking to them actively. So the starting point is still looking at that cash flow forecast. But what you're talking about in those circumstances where you don't actually have you don't know when you're going to return to trading, is understanding what your genuine runway is based on the capital that you've got available. You've got to look at that runway and say, okay, we can, once we've cut down all our costs, a lot of the clients we've got in this space have stood down staff at this stage, haven't made them redundant as such, but have stood them down so they can re-employ them when they have an opportunity. They've been able to reduce as many costs as they can, but there are some that they can't reduce. And there's only so much capital they've got to be able to fund those losses of those costs. So these strategies are still relevant, but the conversations you have are a slightly different tone. And we'll talk about a little bit in the next couple of slides. But in short, it's not relevant to just continue to trade a business through to insolvency. So you do have to take, at some point, a decision on when you need to formally preserve the value and how you can do that. And there's a couple of ways you can do that, which I'll touch on in a minute. And they are through effectively negotiation or administration, which we might sort of flick on to the next slide for now, and I can sort of address this a little bit further as we move into the next couple of slides.
Great, thank you.
So look, understanding your obligations is what I want to talk about next, and this is around directors' obligations primarily. So obviously there's insolvent trading obligations under the Corporations Act, and the government has recently reduced or provided a moratorium from directors from insolvent trading for 6 months. And they've done that specifically because they didn't want directors feeling that they needed to move forward and appoint an administrator because they were concerned with their own liability around insolvent trading. But in my view, that's only gone so far. There are a series of other obligations that directors still have which are relevant. And those are usually fiduciary duties, things like acting in good faith, acting for proper purposes, acting with care and diligence, all of these things, keeping financial records, all of these issues are relevant for businesses that are still in positions where they're potentially trading while insolvent. So I would argue that even though you won't be sued if you're trading insolvent trading, there's a real risk that, with the benefit of hindsight, if the worst case does occur for some of these businesses and a liquidation ensues, that there's a real risk that directors could still be sued for breaches of some of these other duties for allowing businesses to trade when they clearly weren't able to meet the debts that they were incurring. So I put that out there, I guess, as it's just something that directors need to be really cognizant of, because when we're keeping an eye on the future, we're understanding whether or not the business is maintaining solvency. These are some of the risks that will arise for directors. So Tanya, if we can just jump over. So let's talk then about what happens if your plan isn't working. So you've developed your 90-day plan, but your cash flow doesn't get through the 90 days, or you're concerned that at the other end of this, you won't be able to trade through solvently. So the first option is, again, you've identified that issue is there. You've got to deal with it. You've got to be proactive. There's plenty of goodwill available within supply chains at the moment that you can leverage off. One of the, I guess, the comforting things about this, if there is one, is that everybody is in a very similar position. So there is a lot of goodwill from a lot of people that will be within your supply chain that you can go and ask people for additional help and try and renegotiate some of those key cash flow items to get you to a position where you feel like you can trade through and you are solvent. So the main ones though are round 2 attempts to negotiate with financiers and major creditors for standstills. I think we've got a question that's come through here that talks about we haven't been able to negotiate successfully with our landlord. And look, we're getting different feedback from different clients around how successful that is. I must say, by and large, we're getting feedback that most landlords are being reasonable, or most landlords are waiting to see what happens with this commercial tenancy initiative that the government has discussed is going to be something that they put forward a code of practice on. But I guess the wider point here is you make those attempts to try and renegotiate to a position that gets you somewhere that you're comfortable with. If you can't, then you've got to look at your alternatives. And one of those obviously is administration. And let me talk briefly around the concept of hibernation versus administration. Now, the government has coined the term hibernation. I think it was Scott Morrison who discussed hibernation as one of the strategies that they were trying to employ so that businesses, through some of these government support measures, would be able to effectively go into hibernation and be in a position so that when business can return to normal, that they can continue to trade. They can start up again at full throttle, hopefully. The problem with that is, as we've already highlighted, is that for some businesses, this will still mean just either a deterioration of your capital position and potentially going into an insolvency position. Now, the alternative for that is administration. And nobody likes to talk about the concept of having to appoint an administrator or go into what is a form of external administration. But it might be that it is appropriate to some businesses for 2 reasons. The first reason is that you unfortunately have become insolvent and you can't trade out of this at the other end. That's reason number 1. Reason number 2, and I think this is more topical for today, is that you could use administration to stem the bleeding. And while it's probably beyond this seminar for me to go into the nitty and gritty of how this works, but what I will say at a high level is there's the concept of what's called a holding deed of company arrangement. And a holding deed is one where effectively, once an administrator has been appointed, you get through this process the ability to freeze all of the existing liabilities of the company and create a situation where the administrator effectively mothballs the business for a period of time, and the creditors all vote for that. They agree to participate in this, and it reduces the bleeding by removing any of these costs. Now, without going into, again, the nitty-gritty, it's probably relevant to say that those costs that can be quarantined effectively, or those liabilities, are those that existed at the date you appointed the administrator. There is, however, these ongoing costs that you would still need to deal with, that an administrator would still need to deal with, or a deed administrator, if you go into this process. And how do you deal with that? Short answer is it's through negotiation. You still need to go and get your landlord to agree a reduced rent. You still need to get your different creditors that you might be incurring that you can't just stop ordering, for example. Still need to get them to agree. But I would argue that there is a greater opportunity to create a structured and orderly process in a defined period of time that brings all your creditors together in the administration process. That's the real benefit that it provides, is that it brings everyone together in this time frame rather than you going having these piecemeal discussions with everyone. It creates a transparent set of information for everybody to review, because the administrator has to write a report on the financial position of the company. He has to give that, including all the options available, to all creditors, so everyone's got the same information. Everybody can see that the position the business is in. Everybody can understand exactly why they need the accommodations they're asking for. And from that, I think you're in a position of strength to a degree where you can then negotiate with those key creditors, such as landlords, to be able to demonstrate that, hey, I can't just keep going in the current environment, or I'm going to come insolvent. But what I might be able to do with your support is go through this process where you agree, for example, that you don't charge me any rent for the next 3 months. And I agree that I'll still catch up the rent that's currently due from the period before administrator, and I'll keep being your tenant once I can return to normal operations. And if I go back to the question we had before around, I think it was licensed clubs and who've got no revenue, look, it will come down to what your own balance sheets look like. But there is a really good argument to use these types of formats, to use this holding deed through an administration process to be able to try and put the company on pause and stem the bleeding. So look, that's all I really wanted to cover on that hibernation versus administration for now. Just a completely different subject, but within the same realm, is this concept of business model innovation, which I just wanted to touch on briefly. Look, the other thing about being proactive, and if I can give you some examples in our current client base, is there are some of our clients that have completely pivoted their business model to take advantage of certain business infrastructure that they've got. And the obvious examples are those that have moved to an online process or a takeaway process. And we've even had some, in fact, I was talking to one business the other day who is an online clothing retailer, and they have shifted their business model in the last few weeks to now sell online medical supplies. So I think while we're going through some of these fairly standard and although drastic potential cash flow measures and other ways to preserve value, there's also the fact that we've got to keep an open mind and look for potentially other avenues that we can innovate our business model.
And I think too, Shaun, with that is you know, I reflect and look at so many businesses that I've been working with and talking to, and you know, it's rare to have this period of time to actually breathe for many businesses. And I think that, you know, to actually take a step back and look at ways in which you can pivot or ways in which you can create greater efficiency and, you know, and utilize your resources within your business better. It just, you know, it gives people a great opportunity to really look at, you know, what potentially does their business need to be at the other side of this, because I think we're seeing some trends and, you know, some changes that will really have a significant impact on business models going forward. And many of those are in a really positive way. So there's some really good things that we can do to look at it and really question our business models and think, how do we adapt and how do we make the best of the assets that we've got, which could be, you know, everything from your intellectual property to physical assets to your people, to your systems and processes. But how do you take that and pivot it to actually make the best of a, you know, of quite a, you know, serious situation. But yeah, I'm seeing so many great opportunities come out of it, and I think the more that we can sort of understand and see those and you know, share those examples, I think there's a really great opportunity to trigger some great innovation within businesses as well. All right, so we've got a couple of questions just before we go through on the recap, so there was a question there just in terms of sort of rough costs, Shaun, around you know, administration services for a small business. Are you able to give a bit of a guide in terms of what that might look like for businesses?
Look, that's hard to give a one-size-fits-all answer to, but maybe the easier way to demonstrate that is to give some insight as to what the administrator does. So an administrator has some statutory duties that they've got to undertake, irrespective of the type of business. The main ones are that once they're appointed, they need to hold an initial creditors meeting within about a week. They then need to undertake a fairly detailed financial review of the business so they can clearly articulate in a transparent manner to all creditors what is the current financial position, why did it get there, what are the options for the business going forward. And it then needs to hold another meeting of creditors about a month or so after the first one, which allows all of the creditors to attend and then ask questions of the report and then ultimately vote on the company's future. And in the interim, if the business continues to operate, the administrator technically has control of that for that period. That would create greater costs than a scenario that, for example, has the business being mothballed on day one. You know, look, I'm reticent to put a number on it, but I would be very surprised if you would ever see an administration cost less than circa $30,000. I might be wrong depending on the type of business, but that would probably be the starting point.
Okay. Now, just another question that came through prior to the webinar today is just in terms of banks and how will they assess the borrowing capacity of a business when they're ready to commence trading again post, COVID-19. Do you have any thoughts around what that might look like?
Look, that's a really interesting question, because the reality is banks will look at your forecast to try and understand your servicing capacity, and forecasts coming out of this are going to be really difficult. To do, because we're talking about how do you ramp up. For example, let's talk about restaurants. So restaurants that are closed right now, they might, once they get the go ahead to open up, pubs are the same. How quickly are people going to come back, and how quickly is trade going to return? No one really knows that. I would argue, though, as I said earlier, that financiers can be your biggest ally in these periods. So continuing to build a really close and collaborative relationship with your financier and talking to them openly about your issues is probably going to be the best way to get insight as to how those financiers will deal with your requests as you move forward into the recovery phase.
Okay, great. All right, so we've gone through a number of steps today, and just to present you with some options as well. So certainly the starting point is around cash flow, so getting some certainty and some good cash flow modelling in place,
Tanya,
understanding. Yeah, sure.
Sorry to interrupt you. I just saw one more question come through.
Sure.
Maybe we might just take before you
Okay.
proceed. So there's a question there. At what point can we take over from the administrator? The way an administration would work is that once the administrator gets to that second creditors meeting where the creditors vote, there's three options for creditors to vote on typically. The company can be handed back to the directors at that point. The company can enter into liquidation, or the company can enter into a deed of company administration. And if we went into the holding deed that we've talked about in these circumstances, that could be the point in time where the effective control reverts to the company. But the reality is this: the deed administrator still sits over the top in the context that whatever obligations that you've signed up to in the deed, you have to report to the administrator to make sure you're doing it. The deeds themselves can be incredibly flexible in terms of when you have control, what your responsibility for trading the business is, etc. But in short, there's going to be a period of at least 5 weeks, roughly, where the administrator would have control.
Great, thank you. Any final questions there on that? I'll just pause for a moment to see if there's any questions coming through before we take you through the last section of our webinar. I think we're good. All right, so as we've said, we've covered a lot of ground. Oh, we've got one more that's come through. So just quickly, if you're a business who has not yet suffered an impact, but you expect to in the next few months, would you apply for all the relief being offered now, or wait? What are your thoughts around that?
Look, I think it depends on your individual capital position. In short, cash is king at the moment. So if you've got an ability to preserve cash, my first instinct would always be to take that opportunity. You don't know whether or not they'll still be there. That opportunity to take advantage of some of these measures will still be there in 3 months or 6 months. And we don't really know how long this goes on. So subject to what your balance sheet looks like going into this, and I mean, if you've got huge amounts of cash and you can trade for 2 years without having to worry about anything, then I wouldn't bother. But if your balance sheet is not robust enough to last an extended period of time without a little bit of help, then I think it's probably prudent to avail yourself of as many of these measures as you can for now.
Great. So one of the things that certainly is really key, and we've said it, and gone through it quite a bit today, is the starting point is getting that clarity around cash flow, and then sort of understanding all of the levers and building the strategy off the back of it. I think unless you have that clarity in the cash flow and you can get that sort of 12-week look forward position, which is taking all of the information into account that is coming in daily, that's really the starting point before you can even start to talk about strategies and what options that you can take in terms of all the subsidies or the deferral arrangements that are being offered at the moment. And so what we've done is actually put some tools together for businesses to be able to access these tools in a really cost-effective way, and we've built out some models in which you can do that. On the 15th of April, we're running a virtual workshop, so actually taking clients and their advisors and bookkeepers, they can come together and actually build a really robust cash flow model in the same way in which we've just explained. So with all the levers built in, with taking into account all of the cash stimulus, where you can build what if scenarios. So if you are looking for that weekly cash flow model, you're finding that what is in your business is not sufficient for what you need in terms of that granular cash flow management, and you don't have a strong process in your business, have a look at the event that we've got coming up that's on the 15th of April, and you essentially get access to the model, use that in your business, it becomes yours, so we provide the tools for you to do it. And we also have a self-paced sort of online course that you can take and do in your own time. The cash flow that we're looking at, we build it in a Google Sheet environment essentially, but it's great for a collaborative piece, and you can build it and co-create it with people. But you can see on the screen there, this is a screenshot from sort of the final tool, but it's broken up into various tabs, so you can actually find the levers that you need to help build and tap into the cash flow with some what if scenarios, and in a really simple and structured way. We find this is really effective for businesses. So if you're looking for a model, this is a great option, and we'll actually spend the time with you in a virtual workshop to take you through and to build this, and you can involve your advisors, your bookkeepers, and actually end up with a really clear cash flow forecast that then you can start building the strategy from. So I think this is really the starting point, and we're really excited to be able to deliver some tools to assist clients to be able to get to that starting point. So thank you very much for joining us today. I'll pause for any final questions, but our contact details for both Shaun and myself are on screen there. Please feel free to reach out to either of us with any questions or areas that you'd like to discuss further as a result of today's webinar. Shaun, any final tips or thoughts that you'd like to share?
Just briefly, I think this is a situation that everybody's impacted by, and it's a really unique situation. But what's critical in terms of managing cash flow and protecting the value in your business and ultimately the solvency is that you're proactive, and that you build these accountable 90-day plans to make sure that you can get through this. It's not something that's going to go away.
Yeah, that's great. So please, do reach out if there's anything that we can do to support you. If you have any further questions that you want to take offline and contact us with, then please do so. And keep in mind, we do have that webinar on Thursday that's coming up this week, which is specifically around the JobKeeper subsidy. I know we've had a lot of questions come through prior to this webinar on that. If you can hold off till the Thursday where we actually have the legislation and the finalised piece, we've got a great webinar there. So please go to our website and register for that if you would like further information. So thank you very much, everyone, and thanks for joining us today, and all the best going forward.